Bismillahirrahmanirrahim. Dear students, I hope you be fine. This is the start of week number 4, the review of accounting process and practical transactions. Till now we have completed the different parts of accounting, the basic definition of accounting, the purpose of accounting, the branches of accounting, and I have told you the basic importance and vitality of accounting in different organizational structures. Then I also focused on and also elaborated the different forms along with the advantages and disadvantages of different organizations like the sole proprietorship, like the partnership, like the corporation. All these organizations, they somehow using accounting in different forms. If it is a small organization, they are using small accounting system, and if it is a big organization, they are using a big accounting information system. The purpose of this chapter is to review the fundamental accounting process used to produce the financial statements. This review establishes a framework for the study of the concepts covered in this chapter. This accounting process identifies, analyzes, records, summarizes, and then reports any economic event that affects a company's financial position. Here we describe and illustrate a manual accounting information system to provide an overview of the basic model that underlies the computer software programs actually used to process accounting information. What is accounting information system, or what is the process of accounting? Today we practically will go through it, and we practically will analyze the different treatment of financial transactions. Look at the basic model. This is the basic model for your financial transactions, right? You are dealing here with economic events that cause changes in the financial position of the business or of the company. In other words, you can say that economic event is that event that has a very solid impact on your financial position. These events are divided into two categories: external events and internal events. External involve an exchange transaction with another entity, another business organization, another entity, another corporation, while internal, that is the type of economic activity which involve an exchange transaction with another entity internally. Or in other words, we can say don't involve an exchange transaction with another entity. The first objective of any accounting system is to identify the economic events that can be expressed in financial terms by the system. By which system? By your accounting system. Accounting itself an information system that gathers the data, right? If you have in mind the definition of accounting, I elaborated at the very first instance, at the very first starting course of accounting, that accounting is collecting the data from the source documents. What do we mean by the source documents? Are, in other words, the evidential proofs. The evidential proofs are the bills, the receipts, the invoices, the bills, the cash memos, or other documented proof that can prove the transaction, right? Then an economic event for accounting purpose is any event that directly affects the financial position of the company. External events involve an exchange between the company and a separate economic entity. What do we mean by a separate economic entity? By the separate economic entity, we mean a separate business, right? Examples are purchasing merchandise. Merchandise mean the stuffs. The commodities that you will be dealing are the stuffs that you are trading, right? The merchandise are basically the commodities, the stuffs are the items in which you are dealing, right? You will build its inventory for cash, borrowing cash from a bank and paying salaries to employees. In each instance, the company receives something, merchandise, cash, and services in exchange for something else. Cash, assumption of a liability, and cash itself. Internal events do not involve an exchange transaction but directly affect the company's financial position. Examples are the depreciation of equipment, the use of supplies, and adjusting entries. Right? Internal transactions are those transactions for which you are not liable to any outside entity, or you are doing nothing with the outside business corporation, but internally, spontaneously, with the passage of time, with the treatment of different accounting procedures, these transactions are created. And when these transactions created, or when these transaction automatically produces, right, its impact can then be treated in the form of internal transactions, and they are called as your adjusting entries, or the supplies, or depreciation charging. Accounting equation, right? Accounting equation underlies the process used to capture the effect of economic events. It is quite obvious, you might have been told so many times in the class, that the accounting equation portrays the equality between the total economic resources of an entity, its assets, minus, shown on the left side of the equation, and the total claims against the entity, liabilities and equities, shown on the right side. Or in other words, we can say assets minus liabilities is equal to honor equity, assets minus honor equity is equal to liabilities, or the most probably assets is equal to liabilities plus honors equity. Assets are the total economic resources, and liabilities plus honors equity, that is the total claim. Each event or transaction has a dual effect on the accounting equation. The equation also implies that each economic event affecting this equation will have a dual effect, because resources always must equal claims. Accounting equation, the transaction analysis. First, you should analyze your transaction, right? How you will be analyzing your transaction? Consider the first transaction where an attorney invested $50,000 to open a law office. The investment made by the attorney increases cash, which is an asset in the company. This also increases the owner's equity by the same amount, because this is equation, and whatever you are doing on one side of the equation, the same must be represented on the other side, or the impact of the transaction must be shown on the other side. Note that the transaction has a dual effect on the accounting equation, and that the equation is in the balance. What is transaction analysis? You should analyze the transaction. What type of transaction you are dealing with? Cash transaction or credit transaction? Business transaction or non-business transaction? Right? If on the spot you are making the payment, or if on the spot you are making the salaries payment, you are making the payment for rent, that is the cash transaction. But if you are taking the time, right? If you are taking the time, or in other words, we can say that if a time gap is created between the transaction, right, or between the person, or between the organizational time span, if a gap is produces, then this transaction is called credit transaction. A credit transaction always is the transaction where the payment is made at a future later date. Such transactions requires a treatment after a later date. Here in front transaction, you can see you will record $50,000 under the head asset, which is cash increasing, and you will record 50,000 under the head owner's equity, which means capital increases. So both the sides are equal, right? The invested amount of $50,000 by the attorney in a law office, right, that will increase the asset as well as it will increase the owner's equity. Accounting equation, transaction analysis number 2. $40,000 was borrowed from a bank and a note payable was signed. Right. If you analyze this transaction, here again two accounts are involved. One is the asset account, because if you borrow from the bank $40,000, it will increase your cash, because your cash is coming to the business and you are now getting 40,000 more cash. But this cash, on the other side, you have taken a loan from the bank, that will increase your liability. On your part, a liability will be created, and this liability will be paid later on, right? This is current liability because it is a note payable. It depends on if it is less than one accounting period, it is called current liability. But if you will pay this $40,000 within 2, 3, 4 times span, then it is a fixed liability, right? So here the cash is increases, the liabilities also increased, and under the head asset you will record $40,000 cash, and under the head liabilities you will record note payable 40,000. The loan granted by the bank increases cash by 40,000 while creating an obligation to repay it. This increases both assets and liabilities by the same amount. Transaction number 3. Supplies costing $3,000 were purchased on account. Again, a liability was created. An obligation was created. How? Because if you purchase, right, the supplies are the small components, right? Those components which are very in number, right? And due to its small size, you cannot record them one by one, but you as a whole, you call them as supplies in business. For example, you are buying pencils, you are buying sharpeners, you are buying the papers, you are buying the files, you are buying the other necessary stationery type of items, you call them as a whole supplies. So asset increases, right, because supplies purchased will increase the size of your asset. So again you will record 3,000 under the head supplies, and your liability was also created, your liability was also increased just because you are not going to pay the cash on the spot. You will pay this cash $3,000 at some later future date. That's why accounts payable increases. If nothing was mentioned with the transaction, right, then you will consider it a credit transaction as your accounts payable. And this transaction is credit transaction because supplies costing $3,000 were purchased on account. It is quite clearly stated in the transaction that there is no cash payment. Accounting equation transaction 4. Services were performed on account for $10,000, right? A doctor will perform his services, a lawyer will perform his services, right? And anybody else, he is performing his services and he will take a sum of money. So here in this transaction, services were performed. Assets again increases because $10,000 will increase, but as accounts receivable, right? Because you just perform the services and you are not going to receive any sort of payment. The payment will be received at some future date. That's why your asset account increased, and on the other side your equity accounts also increased, because along with the increase in revenues, right, this will increase your asset, and on the other side it will also increase your capital. To go into more details, recall that revenues and expenses, in other words gains and losses, are events that cause owner's equity to change. Only these two things will change the owner's equity. Revenues and gains describe inflows of assets causing owner's equity to increase. Expenses and losses describe outflows of assets or increases in liabilities causing owner's equity to decrease. The transaction states that services were performed on account on credit for $10,000. Service revenue recognized increases owner's equity by $10,000. That you can see here, right? This will increase the owner's equity, right? But this will also increase the asset. right? Asset side will be increased by accounts receivable, since the amount is yet to be received for the services performed. Account receivable increased by the same amount. Accounting equation transaction 5. Salaries of $5,000 were paid to employees. This is a very simple case of cash payment, because your asset side will be reduced by the sum of money you actually pay in terms of salary, and it will also reduce your owner's equity, because your salaries expenses will be deducted from the owner's equity. In the later previous slide, we mentioned that assets, right, asset side and the owner's equity side will be reduced by two aspects: the revenues component and the expense. The revenues component will increase the asset side and will increase the owner's equity, right? And the expenses component, it will decrease the asset side as well as the owner's equity side. This transaction states that the company paid salaries of $5,000 to employees. This is an expense to the entity, thus reducing owner's equity and decreases the cash by $5,000. Transaction 6. $500 of supplies were used. Now you have used the supplies, right? So you will subtract this $5,000 from the asset side from supplies, and you will subtract from the owner's equity, because you did an expense, and always expenses will be subtracted from the owner's equity and from the asset. The company used $500 worth of supplies that was purchased earlier. Assets supplies decreased by $500, and our equity will also be, in response to this transaction, be decreased with the same expense. Accounting equation transaction 7. 1,000 was paid on account to the supplies vendor, right? 1,000 was paid on account to the supplies vendor. It means that the person or the business where from you purchase the supplies, vendor mean the seller, the supplier, the provider of the supplies. In this transaction involves a payment made on account. Made on account means made on credit to the supplies vendor for $1,000. The cash payment decreases assets, cash by $1,000, and a liability, accounts payable, is also reduced by the same amount. So you will subtract this $1,000 from the liability side, accounts payable, and you will subtract this $1,000 from the cash as well. Accounting equation for a corporation. Asset is equal to, now this equation for a corporation, for a multinational corporation or for a big corporation, assets will always be equal to liabilities plus stockholders' equity, right? What do we mean by the stockholders' equity? Stockholders' equity means the parent capital plus the retained earnings, right? Revenues and gains will be added with it, expenses and losses will be subtracted from it, and dividends will also be subtracted. But this slide or this equation will be discussed in the later chapter of financial statements, where we will be building the financial statements, right? Here, very simple equation for you is to calculate the total assets equal to liabilities plus owner's equity. Account relationships, right? After the accounting equation, we will go through the double entry system that refers to the dual effect that each transaction has on the accounting equation. Accounts represent elements of the accounting equation, right? The general ledger collection of accounts are sometimes called the T accounts, used for instructional purposes instead of formal ledger accounts. The term double entry refers to the dual effect that each transaction has on the accounting equation. All transactions could be recorded in columnar fashion as increases or decreases to elements of the accounting equation. However, even for a very small company with few transactions, this would become cumbersome. So most companies use a process called the double entry system, right? Elements of the accounting equation are represented by accounts which are contained in a general ledger. The number of accounts depends on the complexity of the company's operations. Increases and decreases in each element of the company's financial position are recorded in these accounts separately. We will be dealing the double entry system in the later chapter. After accounting equation, there is another chapter which is called the journal, ledger, trial balance, right? All these processes will be done there. Till now, you are supposed to know about the basic functions of accounting equation or the basic treatment of accounting equation on the asset side as well as on the other liabilities plus capital side. Steps of the accounting processing cycle. During the accounting period, step number 1, the source documents, then the transaction analysis, then the journal, then the general ledger, then unadjusted trial balance, adjusted entries, adjusted trial balance, financial statements, closing process and post-closing trial balance. These 9-10 steps are the whole accounting cycle that we will be discussing in the forthcoming chapters. Till now, a simple accounting equation is to tantamount or equalize the asset side and the equity side, or in other words, the liabilities plus capital side, right? Thank you so much.